I have been trading for 8 years and programming for 18 years, and in today's video I'm going to give you guys a beginner's guide to TradingView's strategy tester order functions for entering and exiting trades using fixed take profit and stop losses, using exit criteria, so price patterns to exit a trade, and also using trailing stops and buy limit and stop limit orders. So if you're new to Pine Script coding, this one's for you. We're going to do a really detailed overview of the basics of how to place trades and how to exit trades in the TradingView strategy tester. So if that's something you're interested in, stay tuned. Let's have a look at some code. None of the material in this video is financial advice. I'm experienced in managing my own finances, but I'm not qualified to give anyone advice on what to buy or sell. Everything I do in these videos is purely to demonstrate coding techniques, and the code I write is purely for example purposes. You should always do your own research and due diligence before engaging in trading or investing, and please seek professional guidance if you need it. With that said, let's look at some code. Alright, to start with, let's go over how to set a fixed price stop loss and take profit. So we're using the strategy functions to specify our stop loss and take profit in terms of price values, not point or pip values. So I have some very basic user inputs here just to be able to control our stop loss distance, our risk reward, and our moving average length. We need some indicator values, the ATR value and the moving average. The moving average is simply used for our entry reason. So we're using a very simple entry mechanism. When price closes above this moving average, we enter long. When it closes below, we enter short, and we enter those trades with a fixed take profit and stop loss. So to be able to save our price-based take profit and stop loss, we need to use persistent variables. So these are VAR keyword variables. All that means is these variables do not reset when a new bar begins. So this will save our take profit and stop loss values between bars. The reason we need to do that, as you'll see later on, is because we need to pass those values into our exit function. But before we get to that, let's go over the entry code just briefly. So first we check, can we take a trade? The condition to take a trade is we need to be flat, so no open trades currently. The ATR value needs to be not NA, so we need to have a valid ATR value and a valid moving average value. Then our long and short entry conditions are a cross of price across that moving average, and this must have occurred when the bar has completed, it's closed. We don't want to be entering and exiting trades as price crosses that moving average in real time. We want to enter our trades when the bar state is confirmed. So if we can take a trade, that means we are no longer in a trade and we can safely reset our stop loss and take profit price values. So I set them to NA. This is optional, but it helps us with the display part of our script. When we plot an NA value, that means we're drawing nothing. If I don't reset these to NA, then our stop loss and take profit will continue drawing until a new trade begins. So I reset these purely for visual purposes. Next, we calculate our stop loss distance in points. So I'm using a basic dynamic stop loss here using the ATR value. So we're using a default 14 period ATR multiplied by our stop loss distance input. By default, that's 1. So we're using a 1 ATR value from our entry price as our stop loss. So this gives us our distance. The reason why we need our stop loss distance is because I also have a risk reward multiplier. And so to have, for example, a 2-to-1 risk reward, we need to be able to multiply our stop loss distance by that multiplier. So rather than use this ATR value directly in our stop loss calculation, I calculate the distance separately so that when we enter our trade, here we have our enter long code, we are setting our take profit to the close of the signal bar plus our stop loss distance multiplied by our risk reward. So that's going to be a 2-to-1 risk reward by default. And if I put on a position tool here and bring these values to match our trade, you can see we have a 2-to-1 risk reward on each trade. Now you can obviously anchor this stop loss to anything you want. To keep things simple, I went with the closing price of the signal bar, but we could also get the lowest low value. So we could get the lowest low over the past 10 bars, and we could use that as our stop loss value. and we could adapt our code to work based on a different anchor point. But like I said, I'm keeping things really simple. This is for beginner coders in Pine Script, so we're not going to go over that sort of slightly more complex anchoring. We're just going to stick with this value just so I can go over how the exit function works. So once we've entered a trade, these values store our stop loss and take profit price. And what we need to do now is check. If our position size is positive, that means we are long. The contracts that the strategy tester hold are based on the direction of our trade. So if we're short, we will hold a negative position size. If we are long, we will hold a positive position size. So by checking if our strategy.position size is greater than 0, we can check if we are currently in a long trade. If that is the case, we use the strategy.exit function to exit. This is the comment that will appear on our chart, as you can see where my cursor is. And this from entry is the entry ID that we want to close. So for a long trade, that's obviously going to be long. We could call this anything we wanted to, as long as these two match. So we are exiting from this trade ID. We are passing in a stop price and a limit price. So stop is our stop loss price and limit is our profit limit price. We need to execute this function on every single bar that we are involved in a long trade, and that will maintain those limit orders for as long as our trade is open until one of these is hit. So very simple. That's how you use a fixed price stop loss and take profit in Pine Script. Let's move on to the next script, which is using point-based stop loss and take profit, or pip-based if you're a Forex trader. So here I have exactly the same script, except with one important difference. Instead of having an ATR-based multiplier, we have a fixed stop loss distance in points. So by default, we will have a 100 pip or 100 point stop loss, which is a 10 pip stop loss on the Forex markets. So if I measure our entry down to our stop loss, you can see that's 10 pips distance with a 20 pip target. So all the code here is identical to that first script. The only difference is we don't have to calculate our price-based targets here, or stop loss. We can simply pass in a fixed distance. So here we have our input multiplied by our risk reward for our take profit, and for our stop loss, it's just our stop loss distance. Now in the Forex markets in particular, and most other markets, it's not generally considered a good practice to have a fixed stop loss distance in points, because market volatility ebbs and flows. As you can see just on this chart, we had a period of low volatility through here for a couple of days, and then volatility really picked up through here. And now it's consolidating again and volatility is shrinking. So what we typically want is our stop loss to grow and shrink along with volatility to keep us adapting to markets as they evolve. But there are reasons why you would use a fixed point-based stop loss under certain circumstances. There are some systems that benefit from this approach. Purely from a money management perspective, having a tight stop loss does afford you to shoot for much bigger targets. You will get stopped out a lot more frequently, but I have seen systems that do work with a fixed stop loss distance. It's just not something I would typically do. But it's still important as coders to understand how Pine Script works with all of these different techniques. So let me go over how this exit function works. So instead of passing in stop and limit like we did on the previous script, stop is a price value for stop loss, limit is a price value for take profit. Now we're passing in loss and profit as points. So very simple. However, our drawing code is now a lot more complicated. If I bring up the original script I showed you, our drawing code was really simple because we're just plotting price values, take profit, stop loss, moving average. For this script, we have to actually calculate that price value because our stop loss and take profit is not expressed in price anymore. It's expressed in point distance from our entry. So in order to draw these stops and targets, what I had to do is save them separately as variables, the take profit plot value and stop loss plot value. These are price values. And then I need to calculate the price values by checking if we're involved in a long trade or a short trade, and then getting our position, its average price. So this is our entry price. If we have multiple contracts open, this will be the average price of all of those open contracts if we're pyramiding our trades. I'm not covering pyramiding in this particular video because it adds a whole new layer of complexity that beginners shouldn't really be messing with until they're very comfortable with single target system or single one in, one out systems like these that I'm showing you. But to get our take profit plot for a long trade, I need to add our point distance to our entry price. So once we've entered a trade, I multiply our fixed take profit distance in points. So that would be 2 times this value. So 200 points multiplied by our siminfo.minimum tick value will give me the price of our take profit. And that becomes our green line here and our red line. Now this is obviously optional. We don't need to draw our stops and targets onto the chart, but I find it makes debugging your scripts so much easier if you do make that extra effort. But anyway, that's it for point-based exits. Very simple. We just use the loss and profit parameters instead of stop and limit. So that'll be the last example of point-based systems. It's pretty self-explanatory. For the rest of these scripts, I'm going to focus on dynamic ATR-based stop loss and take profits because that is what is most commonly used by traders who develop price-based technical systems, in my experience. So now let's go over conditional exits. So as you can see here, with same script, however, our exits have changed. We are no longer using a fixed take profit and stop loss. We are now using an exit condition or an exit reason, some sort of pattern in price to close out our trade. So again, we're entering long when price crosses above that moving average, and we're entering short when it crosses below. However, instead of having a fixed take profit, we are now waiting for a higher close or a lower close for a long trade. So for a short trade, we are waiting for, it's hard to see, but this bar here closed just above the bar preceding it, and then we exit on the next bar's open. Same for long trades. This bar here closed below the previous bar's low, so we exit on the next bar's open. Let's have a look at the code. Everything is the same as that first example for our entries. However, we now have these exit condition Boolean values here, these true false values. So as I said, for our long exit condition, if the current bar's close is below the previous bar's low and that bar is confirmed, so it has just closed as a confirmed signal, then our long exit condition will be true. Same for shorts in the opposite direction. If we come down, this code should look familiar. This is our fixed price-based stop loss distance code. We still need to save our trade stop loss price, but instead of using our take profit, we have different exit code now. So now we check if we are in a long trade, our position size is positive. First, we want to check our trade stop loss value to make sure price hasn't hit our stop loss. Now, if we exclude the profit, or sorry, the limit or profit, if we exclude this value or set it to NA, then our take profit will be ignored. So we will remain in this position until our stop loss is hit or the trade is exited for some other reason. And that's what this code here does. If our long exit condition is met, then we close the open trade with the ID of long. So we enter long here with this ID, we close that trade here if our long exit condition is met. We could also say here, close all, and that will close all open positions. So if you're using a one in, one out approach, this is a perfectly fine alternative. Otherwise, you can explicitly say the position you want to close out here. There are other parameters here as well. We could specify the quantity. So we could specify the contracts. Let's say we have 100 units open. We could say we want to close 50 units or 25 units or whatever. We can also use the quantity percent parameter, and this will obviously close out a percentage of our position. So if we set 100, that will close 100% of our position. If we set it to 50, then no matter what our position size is, we will close out 50% of that position. So that's a great way for scaling out of positions. So you could have multiple exit reasons. You could have a profit target that scales out 50% of your position when you hit a 2-to-1 risk reward or something like that. And then you could close the rest of the position when a price pattern is met. To do that, just use the quantity percent parameter, and you can have multiple exit criteria or exit reasons stacked on top of each other. Now, immediately, as far as I know, we'll only work on live market data because it depends on tick values. It will execute the order immediately on the current tick rather than waiting for the next bar's open. During backtesting, we only have access to historical data, so we don't, this parameter will have no effect on historical data. Now, if you're using bar state.isConfirmed for all of your conditional checks, which is recommended for systems which require acting on confirmed values, then that parameter will have no effect anyway. Now, the reason why it's a good idea to wait for confirmed price action before we act on a signal is for situations like this. During this rally, there were a couple of times where the bar would have been closed below the previous bar's low, yet rallied and ended up not closing as a confirmed signal. And so we want to wait for the bar to confirm as a closed bar before we act on it. But anyway, this is how we close a position using a market order on the next bar's open instead of using a fixed limit order or profit order. Moving on, let's have a look at the trailing stop code. If you'd like to learn more about Pine Script, check out our website. I have a completely free 6-hour Pine Script basics course there, which explains the core fundamentals of Pine. And if you want to take your coding skills to the next level, check out my mastery course. We have over 50 hours of content and 50 plus 5-star reviews and growing. The Pine Script mastery course also comes with support where I can help answer any questions you have about Pine Script coding. And of course, there's tons of free content on my YouTube channel. So if you're new to Pine Script, go and check that out too. So this is pretty self-explanatory. You can see that now, instead of waiting for an exit reason or having a fixed stop loss or take profit, we are now trailing our stop loss like a trend following system. So let's have a look at our code. Again, everything is identical to the previous examples for our entry criteria. The main difference here is the way we handle our stop loss value. So we're still saving this trade stop loss price value as a persistent variable, and we're still calculating it when our trade opens, just like we did in the very first example of this video. However, once we are involved in a trade, we now update our trailing stop loss on each bar that closes in the direction of our trade. So to do that, we need to first calculate a new stop loss value. So I've extracted my stop loss distance calculation code into the main scope of my script so that I can continue to reference it during a open trade's progress. In the first example, this stop loss distance calculation was in the scope of the entry code, but now I've taken that calculation and moved it here so that when we are involved in a trade, I can check if the current bar's low minus our stop loss distance is higher than our currently saved trade stop loss, then I override our trade stop loss price value with the new long stop loss value. And then after this check, we pass in this familiar strategy.exit code, which passes in a stop price value. And this is our constantly updated trailing stop loss price. And we do exactly the same thing for short trades, but obviously in the opposite direction. We check if the high plus our stop loss distance is less than our currently saved stop loss, and then update our stop loss if we need to. Very simple trailing stop template code here. Classic trend following technique. Very effective with some systems. Simple, works. I know some of these techniques may look simple using fixed 2-to-1 risk rewards and trailing stops, but believe me when I say over the past 8 years of trading, these things work. There's a reason why they work. Obviously, the edge is in how you apply them, the discretion you use and which filters you apply, the entry criteria, filtering out suboptimal opportunities. That's where the edge lies. But the exit criteria doesn't need to be complicated. By having a very simple trailing stop, you can catch really nice moves like this, where we captured a 6-to-1 profit target with minimal effort on this particular trade. So don't overthink trading if you're new to trading. Simple works. Now let's have a look at stop orders. So here we have yet another sort of trend following approach. However, instead of entering when price crosses this moving average, we are now using a channel breakout technique. So very simple 50 bar channel. The yellow lines represent the highest price over the past 50 bars and the lowest price over the past 50 bars. And what we are doing is placing a buy stop order, 1 ATR above this upper channel and 1 ATR below this lower channel. So this buy here would have come pretty close to entering on our buy stop if I had to guess, but because of the increased volatility over these bars, the ATR value would have been just out of reach here, I imagine. Whereas here, ATR is starting to shrink. We get triggered at the high of this bar here, and then we use a trailing stop to lock in profits. Another classic trend following technique. So let's go over the template code for this one. So again, everything is simple, same as the first few examples. Obviously, we need to get our channel high and low. We just use the highest high and highest low function here to get those values. This should all look familiar now. We're still saving our stop loss as a price value, persistent price value, calculating our stop loss distance for our trailing stop in the main scope. However, our entry code now looks very different. Now we are saying if price is trading above the central moving average, then we're looking to buy a long breakout. So what we do is we use the strategy.order function to place a buy stop order above our channel. So strategy.long tells this order that it is a buy order, and the stop parameter tells this function that it is a buy stop order. If I wanted to use a limit order, then I would obviously change this to limit. We'll go over that next. But for now, remember, a buy stop order is placed above price, and we're waiting for price to come up and cross through it. A buy limit order is doing the opposite. If I had a buy limit order down here, I would be waiting for price to come down and hit my limit order, fill me on the buy, and then rally. That's what I'm looking for here. In the case of a buy stop order, it's the opposite principle. I'm waiting with this order above price, waiting for price to break through it. So essentially, a buy stop order is a trend continuation order, and a buy limit order is a mean reversion order. Typically speaking, if we're placing a limit order below price to buy price, then we're looking for price to come down and revert to the mean. We're buying a dip. If we're using a buy stop, we are buying strength. Totally different approach to trading. Both work in their own context, in their own applications. I have systems that do both. Breakout systems which buy breakouts, and mean reversion systems which buy dips. They're both profitable in their own way. Very different performance metrics, different equity curves, different strengths, weaknesses, vulnerabilities, but they complement each other very nicely. So if you can develop a trend following or breakout system and a mean reversion system that buys dips, and you can trade those simultaneously, you can often get a very nice risk-adjusted performance return on your equity curve by combining those two styles of systems. In fact, here I've added a 1% risk to every trade for this buy stop and sell stop sort of trend following trailing stop system. Very simple, 1 in, 1 out position, no optimization whatsoever, just a 1 ATR stop from the low, and it is a profitable system. 49% rate of return with a 15% max drawdown over 500 trades. Now, it's not an amazing system, but it is profitable with very little work, very little effort, just further demonstrating that simple works. However, before we wrap up with the final example, let me go over something that's important to understand when we're using the TradingView strategy tester to place buy stop orders or sell stop orders. Now, when we place a buy stop order in Pine Script, this order will remain active until we cancel it. So what that means is, once I place a buy stop order, it'll be hard for me to find an example, but if we had a really tight range here and we had a really volatile price action happening, there is the chance that we could get filled on a buy stop breakout, stopped out on that trade, and then also filled on a sell stop order in the same day. And if we don't want that to happen, then we need to cancel our pending buy stop order and pending sell stop order when the conditions for that order are no longer met. Just to quickly demonstrate what I mean, if I change this code here to say bar state is first, what we're doing now is placing a buy stop order at the price 103.5 on the very first bar on my chart. 103.5 is up here. So we'll place a buy stop order right there on the very first bar on my chart. And then this code will not get executed on any of the following bars once that order is placed. So if I save my code here, you can see we placed an order on the very first bar, and the order remained in the market until it was hit by price. The reason it remained is because I never told the strategy tester to cancel that order, and so it remains dormant until price hits it, or I cancel it. So that's an important behavior to be aware of when using entry, buy, stop, and limit orders of any kind. If you want that limit order to expire at some point, if the market conditions are no longer in favor of your setup, you need to explicitly use the strategy.cancel all or the strategy.cancel and then pass in your order ID. So in this case, I want to only place a buy stop order if price is trading above this moving average. As soon as price crosses above this moving average, I want to cancel any pending sell orders that I have still in the market. If you want your orders to expire at a certain point, you need to explicitly include that cancellation code somewhere in your script. Then we just have our familiar trailing stop code from the previous example. Very simple stuff. Let's wrap up this beginner guide to strategy orders with limit orders. So let's look closely here. So this script is buying breaks above our channel and shorting breaks below our channel. This next script is doing the opposite. So now, if you look closely, now we're buying breaks below our channel and shorting breaks above our channel. Now, as I said, I have systems that do both. Depending on how you code it up, it can be a profitable mean reversion technique. Any experienced Forex trader knows that fake outs, stop loss runs, that sort of thing are rampant in the Forex markets. It happens all the time where a key high will get taken out by price and then price will revert back into a range. Doesn't always happen, obviously. If a market's trending, of course it's going to break highs, but it's not uncommon, especially during a consolidation, for price to sneakily blow through obvious key levels and then reverse immediately or soon after. So this sort of technique is very effective for catching those sorts of fake breakouts. So let's have a look at our code. Again, everything is the same. However, our order is now using a limit instead of a stop. And so now we're looking for price to be below our moving average, and then we place a buy limit order 1 ATR below our channel low and a short order 1 ATR above our channel high. Again, we need to cancel our orders if our long condition is no longer met or our short condition is no longer met. We need to cancel that pending order. Otherwise, it will stay dormant in the strategy tester. But yeah, that's it. Very simple stuff. Obviously, we can get a lot more complicated with our entry and exit orders, but this is the basic functionality of TradingView order management with Pine Script. I have a ton of videos on my YouTube channel, strategy videos where I go into much more detail about far more complicated entry and exit techniques. So go and look through my videos, especially my strategy guide in my playlists. I also have a whole course on my website that goes into detail about strategy orders and various techniques and backtesting techniques. So go and check out my course at pinescriptmastery.com if you're new to Pine Script. With that said, the source code to all of these templates will be below in the pinned comment and in the video description, including my previous video on the channel where I showed you guys how to create a profitable mean reversion breakout fading system, which utilizes the sell limit approach. This script you see in my chart right now is doing exactly what I just showed you. However, the yellow and blue line is the previous day's high and low, and we are fading breakouts of that previous day's range using sell limit and buy limit orders and a trailing stop. And you can see we can generate a pretty reasonable portfolio of Forex pairs. And this script here is also calculating my position size based on a percentage of my account balance. So I'm risking 1% of my account balance on each trade here instead of using a fixed quantity like the default strategy tester parameters do. So if that's something you're interested in, go and watch the previous video on my channel. There'll be a link below in the pinned comment as well. Check out my website for more information if you're new to trading or new to coding, and I'll speak with you guys in the next video. Take care and best of luck with your trading.